Welcome to the May edition of Pump the Brakes. My name is Andre Beckles, and I am an independent financial consultant with Harare Wealth Management. I'd like to thank you first and foremost for taking a quick moment to listen to this vlog. But before you go any further, please liking the video is very important. All you have to do is touch it very quickly. You've liked, thank you. But most importantly, the more likes the video has, it acknowledges that the video is out there in the interweb, I like to jokingly say. But most importantly, and not joking, it means that it provides the video more visibility. And these videos are really for financial literacy. So the more people understand about what's going on inside the economy, inside the marketplaces that affect their bottom line on the day-to-day basis, I always say is the better. So please like, and then of course, you can share this video. So by sharing the video, you're doing so with friends, family, associates, foes, whomever the case may be. And they are also being educated about what's going on inside the economy and the marketplace and what is affecting their money on a day-to-day basis. So let's like, share, and of course, subscribe. Subscribe means that you know when I publish a video and I don't have to mention, hey, Mrs. So-and-so or Mr. So-and-so, I just posted a video. I'm sending you this email because I think it's important for you to know what's going on. So you will get either a notification in your email, you'll get a notification on your phone saying that the video is available. So with no further ado, let's touch on what I consider is a top of mind topic within the economy at this moment, and that has to do with the debt ceiling. Some people are hearing about the debt ceiling, maybe a debt default threat. Let's talk about what the debt ceiling is. If we look at it in its most important or most easiest way of stating it, the debt ceiling is basically an agreement that Congress has that they're going to raise the level of spending. They have already agreed that they're going to spend this money, but now they're going to allocate the money for this spending. So most importantly, it has already been agreed that this money is going to be spent there. These are the expenditures. This is the budget. So now we just have to say, hey, we're going to raise our ceiling from where we were spending before to a higher ceiling. And this has been done for quite some time, and I'll touch on that in just a moment. But if we look at it in the definition of the way Congress looks at it, what is the debt ceiling? It's a total amount of money that the U.S. government is authorized to borrow to meet its existing, most important thing, existing legal obligations. So what are some of those obligations? That would be Social Security, Medicare, military salaries, interest on debt, meaning treasuries that they've issued to basically to individuals, to corporations, to other governments. So this is money that has already been issued and interest has to be paid, and also principal has to be paid off. Refunds to individuals and other payments that Congress has already agreed. So as I mentioned, has already agreed upon. So as we're looking at this stalemate between Democrats and Republicans, it's basically a stalemate because it has already been agreed upon by legislators that this money would be spent. So you can liken that to being at home and saying, hey, we're agreeing to buy a car. We went down to, let's say, Toyota, and we purchased the Tundra. And now the Tundra is at home. And now after maybe the first month that Toyota said, hey, you can delay payments. Now it's time to make payments. With that being said, you have to write a check. Well, that's where we are right now. We have to get past that point of saying, hey, we already know that we agreed to spend this money. And now we are going to just say, hey, we're going to check that box off right there. And we're going to allocate funds to meet our obligations. Since 1960 to present, basically, the government has either permanently or temporarily raise the debt limit. And this is a bipartisan thing. So, if we look at it, I said since 1960, so it's been maybe about, say, 50 times that Republican presidents have done it, and about 30 times Democratic presidents have done this. So it has been done for quite a while. I understand the nuances that are there. There are some legislators that say, hey, we have too much debt. And others are saying that, hey, we need to continue to grow the government. And by growing it, we have to issue debt. So, or we have to raise our debt ceiling. So where the stalemate is that there are some people that want to cut the amount of debt that we have out there. And it depends on what programs you feel most comfortable, because I say you, in the sense that you can always tell your senators and Congress people, what you think about things, but they have to decide what they want to make cuts on. There are other people within the various parties that say, hey, no, we've already agreed upon this. So why are we adding cuts to any legislation to raise the debt ceiling? Let's just have a clean bill and move forward. As I have mentioned, that it's been done for many times since 1960. That being said, where are we as far as debt? As a nation, we're at roughly about $31.5 trillion, which averages to about $95,000 per each citizen. The current consternation is whether to raise without any stipulations or to raise with stipulations. And the stipulations, as I say, hey, maybe you cut military spending. Maybe you're going to cut Medicare. But those are things that are very important, and many people don't want to go home to their constituents and say, if you're missing something, when I say something, if you're receiving less benefits, if you're getting less bang for your buck, well, it's because we're cutting the debt. I'm not going to get political in any sense. I just want to let you know what's causing, this consternation. How will it affect the everyday investor? Well, it may, depending on, we have until about, say, June before the government starts saying, hey, we're running out of money, based on the new obligations. So they have until June, maybe around, say, June 11th, I forget the exact date, but there is still time to get a deal done. But in the interim, it can cause volatility to the financial markets because the United States has never defaulted on any of their debt, and their debt is looked at as the highest rated debt in the world, the safest debt to utilize. So other countries borrow, when there are auctions of debt, they come in and buy a lot of the United States debt. So with that being said, that can create volatility in the overall markets. If you're a long-term investor, well, there are many things that cause volatility. I can talk about supply chains. We can talk about a pandemic. We can talk about the housing market. We can talk about bank failures. We can just talk about fears of recession, inflation. There are different things. I call them economic, social, and political events, ESP, that make or shape the overall marketplace, the economy. And with any unknown situation, it can affect your money on a day-to-day basis. And that's what we're here to talk about, is your money. So I just wanted to get out there and mention, if you feel that, we start walking down the next few days, getting closer to the month of June, and there's no bill signed, and all of a sudden, there's, volatility in the market because of this. This too shall pass, as my mom would say about just any bad thing in the world. I always like to say, that was when you did something terrible at home, and she looked at you, and it was, yeah, this too shall pass. So that's my little personal note for the day. But with that being said, we will get past that. We will get past that. I'd like to say there are bigger irons on the fire that this country, these markets really have to deal with at this time. And I'm not saying kick it down the road to lower the debt, because I did mention $31.5 trillion, but not by the way of looking at defaulting on debt. You don't want, you're not going to do that with Toyota to say, hey, I'm going to hide the car because I haven't made car payments. No, you're going to make your car payments. And then you'll address, if your budget seems a lot tighter than it should be, you'll make cuts as you go along. And it should be something that you thought about before you decided to increase your debt. So let's move on. What else is going on that I think is very important to investors at this point in time, everyday people? Inflation. I kind of touched on it just a moment. I know I've talked about it at nauseum in many of the other vlogs that I've done. So let's look at that. What's inflation? Another term for that is the Consumer Price Index. And that data is brought to us by the Bureau of Labor Statistics. That's a department within the government. And for April of 2023, the Consumer Price Index fell for the 10th consecutive month. So there is some good news. There is some very good news. We've talked about inflation. You felt inflation. We've talked about the price of avocados over time, that being one of my barometers of, you go out shopping in the supermarket and you see what's costing you so much. You may have been looking at the price of chicken because of the avian flu. There are many different things, gasoline prices that spreads through the economy that, rises the cost of transportation, then rises the price of everything else. But inflation, we've talked about, as I said, ad nauseum. Since its peak around 9 to about 10% in June of 2022, we are right now at 4.9%, still above the comfort level of the Federal Reserve, which they're looking at 2 to 3%, which is their historic benchmark. So, when we talk about inflation, you hear about higher interest rates, you hear about how that's affected, or it is to affect the economy, to cause it to slow down, because that is one of the tools inside the toolbox of the Federal Reserve to slow down the economy when it is overheated. Overheated meaning that it is it's purring along, but it's purring along too strong, and prices can continue to go up when you have a very strong economy. So that's the reason for raising interest rates. So for the month of April, 4.9%, that's up 0.4%. And the increase versus an increase in the month of March of about 0.1%. The storyline here, what's important that I found inside the CPI report for April, largest monthly increase to inflation that I saw was food, at least the food that you have at home. So still up about 7%. New vehicles up 5.4%. Housing is still, one that is really causing the prices to stay high. So housing up 8%, transportation up 11%, electricity up 8.4%, baby formula up 4.3%, tax prep and accounting fees up 6.4%. So that's why I saw things that were sticking out. I did something a little bit different in this report. I looked at areas where inflation rose the most. So let's take a look at Florida, Miami, inflation at about 9%, Phoenix at 7.4%, Seattle at 7%, Dearborn, Michigan, Detroit area 6.6%, Atlanta at 5.8%. So that is the inflation note that we will speak about. And let's keep things rolling here. Unemployment for the month of April, job gains. Still having job gains. The employment market is still robust. Gains of 253,000 versus the estimates of expecting 185,000 jobs to have been created in the month of April. Now, the running 6-month average had been a lot stronger. So you are hearing about, I've talked about layoffs in tech, but you're hearing layoffs in other sectors just as well. So if we looked at the 6-point rolling average of gains, job gains on a monthly basis, it used to be roughly around 290,000, so just under 300,000. So I attribute that to the higher rates of interest and the work that the Federal Reserve is doing to lower inflation and slow down the economy. As far as unemployed, you have roughly about 5.7 million people unemployed. And we also then had, this is not including the 5.7 million, we have 5.3 million who are not actively looking for jobs in the past 4 weeks. Average hourly earnings, that's your wages, rose by 16 cents or about 50% to, let's keep it at 16 cents. It's not by 50%, 16 cents per hour. And that shows average hourly earnings at $33.36 per hour. And that's actually up year to date 4.4%. So if you say your I can't get this out today. Average hourly earnings are up 4.4%. And I just mentioned inflation is at 4.9. There's a little something, if you're listening, you'd say to your boss, hey, well, inflation is at just about, say, 5%. And my wages have only gone up by about 4.5. That's one of the reasons, other than all the good work that I do, for me to get a raise. Another storyline here, if I dig into the report, industries where I saw growth in the month of April: professional and business services, 43,000 jobs; healthcare added 40,000 jobs; leisure and hospitality added 31,000; social services added 25,000; and financial activities added 23,000. Something that I'm also adding this month that I haven't done before: job openings. Healthcare, because you always say when we're listening to the news and they touch on the thought that there are jobs out there. So I said, well, where are these sectors that there are jobs that people should be made aware of? So where I see job openings, it's in healthcare and social assistance. There are roughly 1.62 million jobs. Accommodations and food services at just under 1.3 million jobs. State and local governments, 920,000 jobs. Retail, just under 720,000 jobs, and manufacturing at 693,000 job openings. So it kind of gives you an idea, not just where the jobs are, but also maybe it kind of gives you a hint at what the earnings would be for those jobs. So what type of jobs are available? The Federal Reserve I touched on before. So if we look at it so far, the Fed has raised interest rates. The last raise was May 3rd, and that was a raise of about 1/4 point. That's the 10th consecutive meeting where they have they've raised rates. So we went from 5 to 5.25. And as I said, this is done to slow down or cool inflation, which unfortunately does create slower growth, which can also mean, situations where you will have layoffs because of their slower growth. There will also be slower spending and the possibility of layoffs, which we have seen. So it affects jobs, it affects the pricing, it affects some of the effects that we've seen is the banking turmoil, the raising of interest rates. Banks that have a portfolio, a large portfolio of long-term bonds, when rates are going up, the prices of those bonds are going down. And it's also affected the housing and mortgage markets because, we've had different spurts over the past few months where rates were high in the bond market. And that would cause people to take a second thought about buying a home at such such a high rate of interest. And then we've had moments when interest rates dropped a little because rates have really been volatile. And that caused some people to jump in and say, hey, let me try and get a deal. I want to get that first time home, or maybe buy a second home, what have you, or refinance for that fact. So whatever the case may be, it does affect definitely affects the housing markets. So I expect to continue to see, as I see overseas, as far as inflation, the European Central Bank, their commissioner there, she has mentioned, it's terrible, I can't think of her name off the top of my head right now. I can see her face, but she has said that inflation is still a worry and we will continue to raise interest rates. Hence, I see no other reason for the Fed to stop unless something crazy really happens in our markets where they don't want to cause any other volatility. But I don't see a pause coming. And let's get into the last part of the video, which really has to do with the performance of the markets year to date. So these numbers, as far as the stock side, are from Friday, May the 12th. Dow Jones year to date, flat meaning not up or down year to date. The S&P 500 up 8%. The NASDAQ, which has more tech stocks inside there, and most of their gains were really garnered in the very first month or so of the year, but up right now 17.75%. The Russell 2000, which is comprised of 2,000 stocks inside this index, but it's comprised of small size companies. That is also flat, down roughly 0.66 year to date, meaning May the 12th, 2023. Bond market, I was just talking about interest rates. You know, what do I see there? Right now, the 2-year, and this is as of noon on May the 15th as we speak, and the 2-year at 4%, the U.S. Treasury I'm speaking of, the 5-year U.S. Treasury at 3.47, the 10-year at 3.5, the 30-year at 3.8. I mentioned last summer, anytime that you see the short-term rate, which would be the 2-year U.S. Treasury, higher than the long-term rate, let's use the 10-year at 3.5 or the 30 at 3.8. When you have that, that generally is kind of a canary in the coal mine for a recession coming, but I'm going to try not to touch on that. I'm going to pause right here for the cause. The pause is, once again, to like, share, and subscribe to the vlog. I mentioned all the reasons why, but I know there is no other reason that you would not want to like, share, and subscribe to the video. So please do so. And I just like to close and say, hey, all of this information, this is my disclaimer for legal. You'll see it in the video just as well. All of my opinions voiced in this podcast are for general information and are not intended to provide specific advice. So if you need specific advice, you contact me directly, or recommendations for any individual to determine which strategies or investments may be suitable for you. Consult the appropriate qualified professional for prior to making any decisions. Sorry for chopping that up. And that pertains to stocks. Investing includes risk, including fluctuation of price and loss of principal. So that's the disclaimer right there. I'd like to say, after reading the disclaimer, thank you for taking some time and listening to the vlog. If you have any questions, again, my name is Andre Beckles. I am with Harare Wealth Management. You can leave a message in this video and I will contact you there. Or if you know my number, hey, reach out and touch. That being said, thank you again, and peace be with you until the next time we speak. Take care.